So read the following information about real estate investing and answer the questions that follow. Buying rental property is an investment option that carries a higher risk than some other options. However, the returns can be good. Assume you have purchased a single-family home that you intend to rent for $850 per month. You will have the following expenses. So, monthly mortgage. So, you're going to charge someone $850 a month, but you're going to pay the bank $390 a month. Your monthly insurance is $60. Your semi-annual property taxes are $340. Your repairs for the year, you're estimating to be about $500. And then monthly lawn care or snow removal is $100. Okay, so we want to calculate the total yearly expenses for this rental property. So this is the monthly mortgage, so we need to figure out how much it is for the year. So we're just going to kind of do all of these. So the mortgage then is $390. That's monthly, and there are 12 months in a year, so we're going to do $390 times 12. Let me do it this way. So for the year, this monthly mortgage is $4,680. Insurance, also monthly, is $60. So we're going to multiply 60 times 12. $720. Semi-annual property taxes. So they're $340. Semi-annually means twice a year. You're going to get $680 there. The repairs are just $500. That's, again, it's estimated. They could be more, they could be less. But that's a yearly estimate. And then the lawn or the snow is $100. Again, it's monthly, so times 12 is $1,200. So then our total, we're just going to add all of those up. 4,680 plus 720 plus 680 plus 500 plus 1,200 is $7,780. So again, we couldn't just add these numbers and multiply by 12 because not all of them are monthly. We couldn't just add them and call it a day because, again, this is monthly, so it has to be 12 of these. Number two, calculate the total rent you will receive in a year. Assume the house is rented for the full 12 months per year. So you're renting it for $850 per month. Mom. 12 months in a year. Yes, Forrest.
I want the Cracker pieces.
Okay. Just one.
Okay. Well, why were they way up there?
Because you were sneaking them last night. All right, so $10,200 is how much you're going to get paid in rent for the year. So your return on investment, remember, we need to figure out the profit first. So you're going to bring in this much money, but you're going to put out that much money. So cash flow in, cash flow out for this property. So 10,200 minus 7,780. So 10,200 minus 7,780 is $2,420. So our return on investment here, remember, is our profit divided by how much money we put out. So $7,780. 2420 divided by 7,780 is about 0.311, which is 31.1%. Okay. But again, these monthly repairs, those were just an estimate. We're assuming it was rented out for the whole year. That could possibly not be the case all the time. Going to the back or the second page, some of your expenses have increased as follows. So if we're going to kind of compare it to this first page. So it doesn't say anything about the mortgage. So we're going to assume that the mortgage is the same because we want the yearly total expenses again. So the mortgage is still the $4,680 for the year. Insurance is now $70 instead of $60. So 70 times 12 is $840. The property taxes, still semi-annual, but now they're $380. So 380 times 2 is $760. And then repairs, no change, so we can keep that at $500. And then lawn/snow is $125 a month instead of $100. And again, it's monthly, so we multiply by 12. Is $1,500. So if we want to go ahead and get our total here, $4,680 plus 840 plus 760 plus 500 plus 1,500 is $8,280. So that's how much now with these increases in our expenses, that's our out-of-pocket cost, our cash outflow. So we want the new return on investment. So we need the profit. So we're still getting this $10,200 from renting out the house. That's the cash inflow here. 10,200 minus 8,280. So now your profit is 1960, 20. I don't know where I got a 6 from. $1,920. Again, how much money you bring in minus how much money you put out. Return on investment is your profit, always in your numerator, divided by your output, the cash outflow, how much money it cost you. So this house cost $8,280 for the year, and the profit was $1,920. So 1,920 divided by 8,280 is about 0.232, which is 23.2%. So what could you do to increase your return on investment? You have a few different options. So some of these things, your mortgage, you can't change your mortgage. Your insurance, you might be able to find a cheaper insurance company, but you want to make sure you still have good insurance. So possibly cheaper insurance. Again, maybe not, because if you get less insurance, you have less coverage. So there's always kind of the give and take there. Property taxes, you can't change property taxes. Repairs, this is just an estimate anyways. So it could be more, it could be less, but you can't predict when things are going to break, or you can with some things, but you have to have that expense. And then the lawn or snow removal, you might be able to see if you can find that cheaper. Cheaper lawn care or snow removal. So those are the ways that you can decrease your cash outflow, but you could also try to increase your cash inflow by increasing rent. So if you increase your rent, you're going to get a larger profit. So those are kind of some of the options you have. So part 7, explain why a positive cash flow is important to owners of rental property. So a positive cash flow, again, what that means is that the rental income exceeds the cost of ownership. So that's kind of what that means. So why is it important that the rental income exceeds the cost of ownership? So you wouldn't want to just charge someone $8,280 here, because then you're going to make no profit. And you also need a cushion, because what if these repairs are larger? Or what if they just need some more maintenance? So by having the rental income exceed the cost of ownership, it allows the owner to make repairs. Forrest,
What?
I said only one.
But I just wanted two.
Just last one then. Sorry, I lost. So it allows the owner to make repairs and maintenance while still making a profit. Otherwise, the owner will pay for these things from another income source. So if you didn't charge them enough rent, if something breaks, you're going to have to pay for that out of your pocket, maybe from your income from working or from somewhere else. But you want to make sure you're making enough money, at least on this property, to cover the minimum, the repairs and maintenance. Likewise, you have to, I wish there were a couple other questions on here. For example, like what if your tenants move out and they're not there for a full year? You still have to pay these bills, even though nobody's living there. So you need to make sure you at least have kind of that extra time covered. Likewise, what if you get somebody in there that does a lot of damage? Your repairs are going to be a lot more than that. Okay. Questions on that one before we move on to the bookwork? No? All right, so we are going to page 375. So the do the math, page 375, numbers 1 through 3. I need to get my book. Sorry, just moving some things around so we can get started. All right, I will try to make it so we can see the book. All right, you have a CD. Remember, a CD is a certificate of deposit for $1,000. The interest rate is 5% annually and the term is 5 years. The CD has an early withdrawal penalty. If the money is withdrawn before 36 months, interest is paid for the time the money is in the account. But a 6-month interest penalty is deducted. Okay, so anytime before 36 months or 3 years, you get the interest, but you have to subtract a 6-month penalty. So if you withdraw the money after 12 months, what penalty will you pay and how much money will you get? Okay, so it's a 5% annual interest. So it's $1,000 times the 0.05%, or 0.05 because that's 5%. So $1,000 times 0.05 is $50. So this $50 is interest for the year. Okay. But it says it's a 6-month penalty if it's withdrawn before 36 months. Well, we're going to withdraw it after 12 months. So a 6-month penalty is going to be half of the interest for the year. So $50 divided by 2 is a $25 penalty. Again, the penalty is for 6 months, which is half a year. And so we want to know, first of all, it asks a couple questions. What's the penalty? So $25. And how much money will you get? So when you withdraw this money early, you're going to get your $1,000 that you put in. You're withdrawing it after 12 months. So you're also going to get the $50 for interest for the year. But you have to subtract your $25 because that's your penalty. So you're going to get $1,025. If you have questions while I'm going through these, please stop me. Number 2, you purchased a house for $125,000. You spent $15,000 for repairs, remodeling, property taxes, and other expenses. You sold the house 1 year later for $160,000. How much profit did you make? What is your return on investment? So, first of all, you have to figure out how much money was invested. What's up, buddy?
Mommy,
Yes, Forrest.
for me.
Hold on, please. So the amount invested here is going to be the amount you spent on the house, the $125,000, plus the $15,000 you spent in repairs. Here, sit on my lap.
Right.
So 125,000 plus 15,000 is 140,000. So that's the amount you invested in this house. All right, you sold the house for $160,000. So for our profit, 160,000 minus the 140,000 you already spent. So 160,000 minus 140,000 this one is $20,000.
Mommy.
And then our return on investment here then. Yes, Forrest.
I want something to eat.
What do you want to eat?
Peanut butter and jelly sandwich.
Okay, I'm almost done. So your return on investment is the $20,000 profit divided by the $140,000 you invested. So 20,000 divided by 140,000 is about 0.143. Again, after the 2 is an 8, so you're going to round it up, which is 14.3%. Yes, Forrest.
No, can I have a peanut butter and jelly?
I have one more problem and then I'll make you your sandwich.
I have one more problem.
All right, last one, number 3 here. You purchased 100 shares of stock at $125 per share. 1 year later, the price of the stock has risen to $150 per share. What is the percentage increase for the stock price? So on this problem, they're giving you more information than you need. So we want to know that in the percentage increase in the stock price. So it was when you first bought it 125 and now it's 150. So the increase,
Is that too loud?
you're fine. Is $25.
No.
It doesn't tell you, it doesn't ask how much money would you make if you sold them right now, nothing like that. It just wants to know what is the percent increase. So for the percent increase, we got the dollar amount increase. For the percent increase, we take the increase, $25, and divide it by the original price of 125. Which is equal to 0.2.